Hello and a very warm welcome to Business Today Television. I'm Siddharth Zarabi and we are discussing the economic survey for the current financial year. And joining me are two of India's well-known economists, Indranil Pan, Chief Economist at Yes Bank, and Rajani Sinha, Chief Economist at CareEdge. Thank you very much for joining in. Before we begin our conversation, I just want to play out for our viewers what was said at the beginning of the budget session of Parliament. Here's a quick slice of those comments.
आज के वैश्विक परिस्थिति में भारत के बजट के तरफ न सिर्फ भारत का लेकिन पूरे विश्व का ध्यान है। भारत का बजट भारत के सामान्य मानवी की आशा आकांक्षाओं को तो पूरा करने का प्रयास करेगा ही, लेकिन विश्व जो आशा की किरण देख रहा है उसे वो और अधिक प्रकाशमान नजर आए। मुझे पूरा भरोसा है निर्मला जी इन अपेक्षाओं को पूर्ण करने के लिए भरपूर प्रयास करेगी।
Prime Minister Narendra Modi there providing us a cue of what can be expected from the budget. The focus obviously from the Prime Minister's comments that one can make out is that it will continue to focus on Bharat and the Aam Aadmi, a very significant number of people. Meanwhile, what we have learned so far about the state of the economy as will be captured by the economic survey, and I'm going to provide you some of the key points, including the expectations on the headline GDP growth numbers, and then go across to our guests on the state of the economy and what to expect as we count down to the budget. India is expected to witness GDP growth of between 6 to 6.8% in fiscal 24. That's the next financial year. And for the current year, the projection is at 7%, which is in comparison to 8.7% in the previous financial year. The economic survey, as we have learned, is projecting a baseline GDP growth of 11% in nominal terms and 6.5% in real terms for FY24. So between 6 and 6.8, the forecast, really the number that we are going to discuss with our economists, is 6.5%. Capital expenditure rose by 63.4% in the first 8 months of the current financial, and that is being attributed to government investment, and therefore the result being continuing as a key driver of the Indian economy. As far as inflation is concerned, the survey maintaining the RBI projection for headline inflation at 6.8%, which is definitely outside the target range, but clearly, as we know, inflation, there are some signs that in certain aspects it may be peaking, although core inflation continues to remain worry. The survey has also pointed out to a lower forecast for growth in global trade by the World Trade Organization from 3.5% in 2022 to 1% in 2023. And I must add for our viewers, the latest IMF forecast projecting two crucial things. One, that India's economy will be the fastest growing economy, and the second bit, that they are seeing a recovery as far as global economic growth is concerned, and that is consistent with some of the expectations that global economic growth may not suffer as much as was being anticipated last month or even earlier this month. I'm coming to you, Indranil, to kick off our discussion. The headline growth numbers and the government putting them on paper, what do you make of it in terms of the future prospects as well?
Well, obviously, as you rightly said, India continues to be one of the fastest growing economy. That's the bright spot. But having said that, I think the 6.5% number that you just mentioned probably to me looks to be on a slightly higher side, but is relevant given the fact that you have an 11% projection in terms of the nominal GDP. And if that number is taken in the budget, that will also determine the revenue numbers and therefore the elbow room that the RBI the government would have in terms of allocating for the revenue expenditure and the capital expenditure. The one thing that remains very important in this budget is to see how capital expenditures are projected and how they pan out through the year. Because my fear is that given the haziness in terms of the private consumption demand, both from the domestic side and the global side, it has to be continuing to be the government who has to hold up the flag for the economic growth.
Rajani, I'm coming to you with that same question and the added bit about if the government is the one that has to continue to uphold economic growth, then what does that mean in terms of the fiscal consolidation or compression that we are likely to see in the forthcoming budget?
So I agree with Indranil as far as the GDP growth projection is concerned. 6.5 looks like towards the higher end. Our estimate is around 6 to 6.1%. And the main concern right now is the global slowdown. Because, with this whole story about coupling and decoupling, we still feel that the global slowdown will have an adverse impact on Indian economy, but not a very severe impact. And hence, we are still expecting a growth of around 6 to 6.1%. Now, coming to your other question of what does this mean for fiscal consolidation? Yes, with growth slowing to around 6.1% or so in FY24, we are expecting nominal GDP growth of around 10 to 10.5%, and hence the gross tax revenue collection is likely to moderate. From the very high growth in tax revenue collection that we have seen in FY23, that is going to moderate. So to that extent, it's going to be a challenge for the government to move towards the path of fiscal consolidation. But we feel that government will focus on moving towards fiscal consolidation, and the fiscal deficit is likely to reduce to less than 6%. We are expecting around 5.8% or so. Now, where are they going to get the money for this? Well, we expect, one, like I said, tax revenue growth is going to moderate, but we are expecting higher collection from non-tax revenue growth. So some comfort from there. And then as far as the expenditure is concerned, there could be moderation in subsidy expenditure also. So that's again somewhere it will provide some leeway to government to focus on capex. And as far as capex is concerned, while I feel that focus on capex will continue, but given the very high base of capex that the government had budgeted for FY23, I do not expect a very strong growth from here on. So I feel that from the number of 7.5 trillion, probably a growth of around further 10 to 15% on this number for FY24. So given these circumstances, I still feel that government will move towards fiscal consolidation in FY24.
Okay. Indranil, to your earlier point, and this is again source-based information about the state of the economy and the upside or the reasons for the buoyant outlook, if I may call it that have been provided. The survey makers believe that the upside for India's growth arises from limited health and economic fallout for the rest of the world from the current surge in COVID-19 infections in China, and therefore continuing normalization of supply chains. Basically, the end of zero COVID and its impact. The second, inflationary impulses from the reopening of China's economy turning out to be neither significant nor persistent. The third, recessionary trends in major advanced economies triggering a cessation of monetary tightening and a return of capital flows to India amidst stable domestic inflation. So the rationale for this kind of outlook is, from what we understand, the following three reasons. Indranil, how would you respond to those three reasons? Would you agree with them or do you have a bone to pick with them?
Yeah. So let's move away from the nitty-gritty discussion of whether Rajni's 6%, 6.1% is correct, or whether the economic survey 6.5% is correct. But what I hear from you is the broad understanding is that there is a sense of stabilization of the economic environment. Remember, as we had come out of the COVID and as the world was opening up, we were hit by the supply chain issues from the Russia-Ukraine crisis. So we are not really expecting at least no worsening of that crisis, but the opening up of China may actually do something relatively better in terms of the supply chain atmosphere in the global economy. The second thing, of course, is that the inflation is coming down world over. The shock in terms of the inflation going up to say an 8 and a 9% in the global economy is moderating. But I would still be hesitant to clearly call for most of the economies' inflation having reached the target in 2023, which necessarily means that yes, there will be a cessation in terms of any further or any aggressive interest rate tightening by the global economies, including that of India. But I personally would not expect any reduction in the interest rate or reduction or easier financial condition in 2023. So the global economy is a mixed bag. There are a lot of moving pieces and uncertainties, but the sense that I get is more of a stabilization rather than an upside. And if that happens, this will obviously help India in terms of all the parameters, be it economic growth, be it the inflation, be it the budget making exercise, and also the elbow room that the government would much necessarily seek in terms of pushing forward with its capital expenditure plans.
Okay. Rajni, the point about stabilization, and this is an important one because after 3 years of almost non-stop uncertainty and black swan events, what everyone would expect is that let things remain stable. You know, even if the vehicle is running on a road at 40 kilometers per hour, that's good, but it shouldn't move in stop and start. Is that the best hope we can have at a time when the global outlook is certainly cloudier than it was in the recent past?
Definitely, Siddharth. While things are improving, in the sense that a lot of data indicators that are coming from global economies are turning out better than market expectations. Inflation is moderating, so it appears that the slowdown that we have been fearing could maybe will not be very bad. But the point is, as far as uncertainties are concerned, there are still a lot of uncertainties, and we definitely need to be very cautious. For example, even if we are talking about inflation moderating, it's moderating, but if you look at the major economies with inflation at 8-9%, it's still very high, much higher than their target of 2% or so. So most of the economies are still struggling with high inflation. As far as monetary policy is concerned, while the market is factoring in that probably say US Fed would start cutting rates by the end of the year, not too sure whether that will actually play out because the Fed has not been indicating that. So, in that sense, I feel the risks are still in the market, still in the global economy, and we need to be very cautious. The good point is that maybe things will not turn out as bad as we have been fearing.
Okay. Indranil, one of the points that is sort of dwelt upon here is that budgeted capital expenditure rose 2.7 times in the last 7 years, and these 7 years start at FY16 and up to the current up to FY23, and this is said to have reinvigorated the capex cycle. What's your own sense about this number and its relevance? Because 2.7 times over a period of 7 years, is that the best we could have hoped for, or does it also reveal the structural inefficiencies that we have in terms of execution?
Well, I'll sort of try and answer your question in a slightly different way. I'm not really looking at the 2.7 times increase that you talked about. But in the recent years, what has also been happening is that the stated capital expenditure boost of the central government is not really apples to apples. It is more apples to oranges because they have brought in the airlines, sort of the Air India accommodation within the capital expenditures. They are now giving a much higher amount for the state governments to spend. And more importantly, they are trying to reduce the extra budgetary borrowings and is trying to put it on the budget balances. Now, if I have done my calculations correctly, the FY23 BE over FY22 RE, adjusting for all these noises, the capital expenditure of the central government is likely to have increased by only 7.8%. And if inflation is at 6.8%, the real increase in capital expenditures is just about 1%. Now, that possibly is not enough. The second aspect of capital expenditure is that most of what we hear is expenditures towards roads and railways, because that is where the central government has a better handle on. We don't hear much in terms of the other capital expenditures. We have not really much heard about the Bharat Mala and the capital expenditures in other areas such as ports, which are also very important. So to a certain extent, my fear is that whether we could be reaching at some sort of a bliss point in terms of the absorptive capacity for the Indian economy, given also challenges in terms of the land acquisition, etc., etc. And that could be a real struggle in terms of implementation of very sharp increases in the capital expenditure over the next few budgets.
Point, because let's just take, for example, the bullet train project, and despite all the political capital that is being invested, there are delays. Rajani, I have one last question for you as well. The scenario for global growth, according to the survey makers, and they say that it presents two silver linings. One is that oil prices will stay low and India's current account deficit will be better than currently projected. And they conclude, and this is as per sources, the overall external situation will remain manageable. How would you respond to this?
Siddharth, this is our base case scenario too. This is what all of us are hoping, that external scenario remains stable. But like I mentioned earlier, there are too many uncertainties and it's difficult to say whether this base case scenario will play out. For instance, crude oil prices. I mean, if I look at the supply side, the sharp increase in prices that we saw a few months back, that was mainly because of supply side reasons. And any of those reasons can again flare up. But yes, the comforting factor is that if we are talking about global economy slowing down, the demand is going to remain muted and hence that would keep the prices around these levels. But we cannot rule out the risk that there could be a supply bottleneck again emerging, because of which prices could flare up. But yes, in the base case, we are also assuming that commodity prices will remain around the current levels. Because with global growth slowing, as long as the supply bottlenecks are not again emerging, prices would remain around the current levels. And as far as the global slowdown is concerned, again, as I mentioned, the data indicators are showing that it may not, the slowdown may not be very sharp. And if that's the case, that would definitely benefit Indian economy.
Okay. Indranil, there's also a comment and a cautionary one at that about the challenge of the depreciating rupee. With all that we have discussed, what's your own view? Although the rupee has been, I think, better performing than other currencies, there does seem to be a certain persistence of depreciation that we may see with whatever the US Fed does, for instance.
Absolutely. So per se, as an economist, I don't think one should be worried about a depreciation, because obviously it corrects for the competitiveness or the competitiveness gap that is there. But the other thing that it also says is that if I were to wish for lower depreciation, India's productivity rather than only the GDP needs to actually improve. So that's where the crux of the budget would be also, in the sense that we need to now look at more in terms of productivity gains. Growth alone will not do the trick for the Indian economy in terms of pushing it out of the middle income trap, or even sort of improving the per capita income. It has to be more a productivity led growth. Therefore, I think the government, to a certain extent, is on the right track in terms of the capacity spend or the capital expenditures, the PLI schemes, etc. But a lot more needs to be done in terms of the healthcare, the education, in terms of the input-output gaps between in these sectors going forward. So these are some of the focus areas that needs to be looked at in a very significant way if we were to wish away depreciation of the INR. But overall, to answer your question directly, I do expect depreciation of about 3.5 to 4% in 2023. Yes, dependent on how hawkish or how dovish the Fed is. And to that extent, there could be a reasonably sort of direct approach of the Reserve Bank of India, even in terms of stopping the depreciation of the currency if need be.
Okay. Indranil, while you were speaking, my producers are telling me that the survey has finally formally been tabled, and hopefully we'll be able to show Nirmala Sitharaman, the finance minister, doing this very important activity, the economic survey, essentially a state of economy, or if you may call it a three-quarter review of the Indian financial year from the central government point of view. There is a mid-term review, but the survey, the time that it takes to prepare, the exhaustive inputs that are gathered, and much of the commentary which is very good for academic and research and analytical purposes is contained in it. So a three-quarter review which provides us some hints towards budget and policy making. The fiscal deficit, for example, does not really get captured in this survey, but a growth outlook is definitely captured. And as we extend this discussion by a few more minutes, I would request both of you, and coming to you, Rajani, we just briefly dwelt on inflation. I just want to come back to it. What's your own sense of how inflation is likely to pan out, at least for the next quarter or beyond, if you have visibility into that?
So, we are expecting inflation to moderate from the current levels. It has already gone below RBI's target of the target band, the ceiling of 6%. It has gone below that. And actually, for the full fiscal year for FY24, I expect it to be around 5% or so. And the main reasons we are basing it on is, one, there'll be a little base effect in play. Second, we are expecting commodity prices to behave, to probably, remain around these levels. And we in base case, we are assuming there's no further spike. So, and then, the moderation in demand that we are talking about for next year, that will also have a role in pulling down core inflation a little from the current high levels. So, with domestic pent-up demand fizzling out, with base effect working, with all the rate hikes that the central bank has done so far, that having an impact. Overall, for next year, I expect inflation to moderate to around 5% or so.
Final comment on that, even as I am informed that the Lok Sabha has been adjourned. We will now have occasion to go through the entire survey. But a final comment from you, Indranil, on the inflation number that you are working with today.
Yes, the inflation has come down. But as I said even previously, we are not really sure whether inflation comes down to target for across the globe. And therefore, I am not expecting inflation, even as a touch level, we reach a 4%. The broad sort of indication from my side on an average basis, inflation will be higher than 4% during this year. We are working with a 5.2 or 5.3% average inflation for FY23 after a 6.7% inflation average, the retail inflation average for the current financial year.
Okay, those are key and significant numbers, and viewers, we are now counting down to the budget, and the budget, as is expected by most participants, including the two economists who've been here with us for the last half hour, a fine balancing exercise, and we'll see how the balancing exercise goes on. It is, remember, the Modi government's second term's last full budget, and while there may be expectations of populism, a populist budget, given that it is pre-election year and there are 9 state elections, I think Prime Minister Modi provided us a hint in his short comments at the beginning of the Parliament session about the real priorities that the budget will have, and he named Finance Minister Nirmala Sitharaman during those comments. So those are the key takeaways. Indranil, Rajni, thank you very much for your time with us today. With that, it's a wrap on this show. We'll be back with more. Do stay tuned in. Goodbye.